So, we've all been seeing the headlines about Singapore's HDB resale market, right? After what feels like a forever climb, prices have started to, well, shift a little. But what does a tiny dip really mean? Is this a big warning sign for sellers, or is it the golden opportunity that buyers have been desperately waiting for? Let's get into it. This is the million-dollar question, isn't it? When a market that seems to only go in one direction, up, suddenly takes a little dip, it's totally natural to feel a bit on edge. Is this the first little tremor before a big earthquake, or is there something else going on here? Okay, before anyone panics, let's just ground ourselves with the actual number. We're talking about a pretty modest decline here, around 1.6%. Yeah, it's a noticeable change for sure, but it's so important to keep the scale in perspective. This is not a market in free fall. And that, right there, is the key. That's the main takeaway. What we're witnessing isn't some dramatic crash. It's what the experts would call a market breather. A totally necessary pause, a little adjustment after years of just nonstop growth. This whole process has a name. It's called market normalization. Think about it like this. If the HDB market has been climbing Bukit Timah Hill for the last few years, this isn't falling off a cliff. Nope. It's just a short, gentle, downhill part of the trail that lets everyone catch their breath before the path starts to level out. It's all about shifting towards a more stable, more balanced market. So, the big question is, why is this happening now? To really get that, we've got to look at the two forces that run everything, supply and demand. Let's break down what's really driving this change. First up, supply. And this is a big one. We're seeing a huge surge in supply. For years, the market was super tight, right? But now, thousands and thousands of HDB flats are hitting their minimum occupation period, their MOP. And boom, suddenly the resale market is flooded with fresh options. This instantly takes the pressure off buyers to outbid every single person in the room. And this slide right here shows you exactly what that feels like. Not that long ago, if you were a buyer in, say, Tampines, you might have only seen 5 or 6 listings. And that just sparked crazy bidding wars. Today, that same buyer could easily be looking at 15, maybe 20 listings. The whole dynamic has completely flipped. It gives buyers real negotiating power and forces sellers to be, well, a lot more realistic. But it's not just about supply. The buyers themselves have changed. The pressure on our wallets from the wider economy is making people so much more careful, more deliberate with their choices. The days of just buying out of FOMO, fear of missing out, are starting to fade. Here's how that thinking goes, right? Higher interest rates mean your monthly mortgage payments are higher. So families are sitting down, they're reevaluating their budgets, and they're making really disciplined choices. Things like capping their maximum price, or maybe deciding on a 4-room flat instead of stretching themselves thin for a 5-room. So when you combine that rising supply with more cautious demand, what do you get? You get a fundamental shift in the market's power structure. We're moving away from a market that was totally dominated by sellers to something much, much more balanced. Of course, you're still going to see those crazy headlines about million-dollar HDBs, but it is so crucial to remember they are outliers. They are the exceptions to the rule. We're talking rare, perfectly located, super high-floor units. They absolutely do not reflect what the average person is experiencing in the market. This table here pretty much sums up the entire shift perfectly. Before, sellers could name their price and buyers had to make these super rushed decisions. Now, sellers have to adjust what they expect to get, buyers can actually take their time to compare options, and, this is the big one, negotiation is back on the table. The power is just more evenly spread out. Okay, so with this whole new landscape, how do you play your cards right? This isn't a time to get scared and step back. It's a time to be smart, to be strategic. Here are 3 key moves from the Smart Investor's Playbook. First and foremost, forget about trying to perfectly time the market's absolute bottom. It's pretty much impossible, so don't even try. Instead, focus on what really matters, the fundamental quality of the property itself. A great property at a fair price is always, always a good investment. So here's the bottom line. Buying a well-located flat, maybe near an MRT station, for a fair price today is a much smarter, much more resilient investment than just gambling on a poorly located unit at a slightly cheaper price, just kind of hoping the market will lift it up for you. Quality is its own security. A cooling market is a reward for patient and observant buyers. Look, not every seller is in a rush, but some are. They might be upgrading, or maybe they need the cash urgently. These are the situations where amazing opportunities for a great deal can suddenly pop up. And this can make a huge financial difference. Just imagine a seller lists their flat at $650,000. After a few weeks with no serious offers and a softer market, they might just accept $620,000. That $30,000 difference for the buyer? That's not just a discount. That's enough to cover a huge chunk of your renovations. And finally, be strategic about where you invest. The most resilient part of the HDB market is always the part driven by affordability. And that means you want to focus on the types of flats that have the biggest and most consistent pool of potential buyers down the road. This chart just makes it crystal clear. The demand for 3- and 4-room flats is incredibly deep. Why? Because they serve first-time buyers and budget-conscious upgraders. Those larger, more expensive executive flats, they have a much smaller pool of buyers, which makes them way more sensitive to price shifts. So you want to invest where the demand is strongest. To really bring all this together, let's look at a story we can all relate to. This isn't just about numbers and charts. It's about how these big market shifts affect real families making one of the biggest decisions of their entire lives. So meet the Tan family. In the super hot market of 2022, they were hunting for a 4-room flat, facing hardly any choices and feeling all this pressure to bid way over valuation. Fast forward to today, in this more balanced market, they have options. They can actually negotiate a fair price. For them, this market dip wasn't a crisis at all. It was the exact opportunity they needed. So let's circle all the way back to our original question. This slight dip in HDB prices, it is not a warning sign telling you to run for the hills. It's a signal that the market is resetting. It's becoming more rational, more balanced, and more driven by real fundamentals instead of just hype. And that leaves us with one last thought. In a market where some people see doubt, a good strategy reveals opportunity. The power is shifting. The whole board is resetting. So the only question left is, are you going to be the one to make the smart, disciplined move